Hi, my name is Findolax. Have you ever had that?
Whoop, whoop. Have you ever had that moment you're at a family dinner or maybe out with friends and someone starts talking about their investments? They're bragging about this hot new fund, this genius stock pick, how they're beating the market. And you're sitting there nodding politely while inside you're thinking, should I be doing that? Am I missing out? Is my boring index fund stupid?
That feeling has a name. It's called FOMO, fear of missing out. But in the investing world, it's more than just a feeling. It's a multi-billion-dollar industry designed to make you doubt the simple, smart choice. And that doubt costs the average investor tens of thousands, sometimes hundreds of thousands of dollars over a lifetime.
That's exactly what we're uncovering today. We're diving into the brilliant work of researcher Max Bazerman, specifically Chapter 7 of his book on judgment, which exposes the 5 psychological blind spots that trick smart people into making costly investment mistakes. By the end of this, you won't just understand why your friend's strategy is likely a trap, you'll feel empowered and confident in your own.
And more importantly, you'll have a clear, actionable plan to build real, lasting wealth without the stress.
Let's start with the most seductive mistake, chasing past performance. Your friend's fund beat the market for 3 years. That's not a coincidence, right? That's skill.
It feels like skill. Our brains are pattern recognition machines. We see up, 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 and we think winner, winner, winner. But the market isn't a machine. It's a casino with 8,000 slot machines, and every year, by pure randomness, about 2,000 of them will light up and say jackpot. Just by chance? Absolutely. Now, the next year, of those 2,000 winners, about 500 of them will hit jackpot again. The year after that, about 125. So we will always have a group of funds, 125 of them, on a 3-year hot streak purely from random luck. The financial media then finds these 125, interviews them, puts them on magazine covers with headlines like, "The Fund That Can't Lose."
And we think they've cracked the code.
We do, but the legendary John Bogle, founder of Vanguard, did the real analysis. He tracked the top 20 performing funds of the 1980s. Where did they rank in the 1990s? On average, 142nd out of 309, middle of the pack. The hot hand had gone stone cold. You're not picking a skilled surgeon, you're picking a lucky lottery ticket that's already been scratched. The tragedy is, by the time you hear about it, the luck has usually run out.
So the first rule is, past performance is not a promise. It's often a probability trap.
Exactly. It's a story we tell ourselves to feel safe about predicting an unpredictable future.
This belief that we can spot the next winner leads directly to mistake number 2, overconfidence. We think, maybe I can't pick the winner, but I can pick the stocks, or my expert advisor can.
And this overconfidence has a price tag. Professors Brad Barber and Terence O'Dean conducted a landmark study. They looked at tens of thousands of real brokerage accounts over 6 years. They found the average investor turned over 75% of their entire portfolio every single year.
That's a constant churn of buying and selling.
It's financial hyperactivity, and it's expensive. Every trade has a cost, a commission, a spread, a tax implication. Their research found the most active 20% of traders, the ones most confident in their timing, underperformed the overall market by a staggering 6.5 percentage points annually. They weren't just wrong, they were expensively wrong. They paid a 6.5% confidence tax every year. Precisely. And here's a fascinating social layer. Men and women displayed this overconfidence differently. Men turned over 77% of their portfolios annually, women 53%. That difference in behavior cost men about 1% more in returns each year.
So women are better stock pickers?
No, the returns on the stocks they picked were similar. The difference was in the behavior. Women were better at sitting still. In a world screaming at you to do something, the most powerful move is often to do nothing. Overconfidence tricks us into believing activity equals competence. In investing, disciplined inaction is the higher form of intelligence.
Mistake number 3, false optimism and the stories we tell ourselves. We're overconfident about our future actions, but we're wildly optimistic about our past results. We think we're doing better than we are.
This is perhaps the most heartfelt mistake. Researchers created an investment simulation using 10 years of real market data. They gave MBA students $100,000 to invest. At the end, the students were asked, "How did you do compared to the market?"
What did they say?
The average participant underperformed the market by 8%, but when asked, the average participant believed they had matched the market. Not only that, at the start of each period, they predicted their portfolio would grow by over 8%. The actual growth was 5.5%.
So they were optimistic about the future, and then they rewrote the past to be optimistic too.
Yes, our memory isn't a hard drive, it's a storytelling device. We vividly remember the one stock we sold for 50% gain. We call that our savvy move. We blur the memory of the 3 stocks that tanked. We call that market volatility or being patient. We protect our ego by editing our financial history. This is why most people never, ever pull out their statement, calculate their personal rate of return, and honestly compare it to the S&P 500.
Ignorance is bliss.
But it's a bliss you pay with your future. That false optimism is the fuel that keeps us chasing the next hot fund, listening to the next guru, and staying in expensive, underperforming investments. We'd rather feel good and be poor than feel uncomfortable and rich.
Mistake number 4, anchoring and mindless allocation. Here's the great paradox. We're hyperactive with stock picking, but we're comatose about the single most important decision, asset allocation, the split between stocks, bonds, and other assets.
It's the ultimate majoring in the minors. We'll spend 10 hours researching a single company, but 10 seconds deciding how to allocate our life savings. A study of university professors, smart people, with TIAA-CREF retirement plans found most just split their contribution 50-50 between the stock fund and the bond fund, and then never changed it for their entire career. The median number of allocation changes was 0.
They said it and literally forgot it.
Another study found that for regular employees, their stock-bond split was almost perfectly predicted by the menu their 401k plan offered. If the plan had 4 stock funds and 1 bond fund, employees put about 75% in stocks. 1 stock fund and 4 bond funds, 75% in bonds.
So we just order 1 from column A and 1 from column B.
Exactly. It's the diversification salad approach. It feels diversified, but it's mindless. Your asset allocation is the captain of your ship. Picking individual stocks is just rearranging the deck chairs. We spend all our energy on the deck chairs while the captain is asleep at the wheel. This is anchoring, latching on to that first 50-50 split, and status quo bias, the path of least resistance, in perfect, expensive harmony.
Mistake number 5, prospect theory. Selling winners too fast and holding our losers too long.
This is Nobel Prize-winning prospect theory in action. Our brains feel losses about twice as powerfully as we feel gains. So when a stock is up, we're risk-averse. We think, I'd better sell and lock in this gain before I lose it. When a stock is down, we become risk-seekers. We think, if I just hold on, it'll come back. I can't sell and make the loss real.
But the price we paid is in the past. It's a sunk cost.
It's a psychological anchor. The only rational question is, if I had cash today, would I buy this investment right now? If the answer is no, you should probably sell. But we don't do that. Terence O'Deem's research shows the stocks investors sell, their winners, go on to outperform the stocks they keep, their losers.
So we're systematically making our portfolio worse.
It's a triple whammy. First, you incur trading costs. Second, you gut your portfolio of its best performers and load it with its weakest. Third, from a tax perspective, this is backwards. You should want to realize losses to offset gains. Instead, we realize gains and defer losses. Our ancient brain wiring, designed to avoid immediate pain, is sabotaging our modern financial well-being.
Now, let's look at the Hall of Shame and the action plan. These mistakes created legends, cautionary tales, the late 1990s day trading craze.
A study of 324 day traders during the tech bubble found only 36% were profitable before taxes. After short-term capital gains taxes, almost none. They were playing a negative-sum game against professionals with better information and faster computers.
And the Beardstown Ladies Investment Club.
A beautiful story of grandmothers beating Wall Street. They claimed 23% annual returns for a decade. A reporter found they'd accidentally included their own monthly membership dues as investment returns. Their actual return was 9%, underperforming the market's 15%. Their story wasn't about skill, it was about an accounting error. Yet it inspired thousands of clubs that, on average, also underperformed due to overtrading.
So what's the cure? The action plan?
It's simple, but it requires going against your instincts. 1. Automate your savings. Use a Save More Tomorrow plan. Commit now to investing half of every future raise.
2. Embrace the boring core. Make a low-cost, total stock market index fund the bedrock of your portfolio. Own the whole market. 3. Allocate with intention. Choose a stock-bond split based on your age and sleep-at-night factor. Write it down. That's your policy. 4. Implement a Do Not Disturb sign. Schedule one money date per year to rebalance. Ignore the noise the other 364 days. 5. Change with care. If fixing old mistakes, do it slowly and tax smartly. Be kind to your past self. The greatest edge in investing isn't a secret formula, it's self-awareness. It's understanding that the market's job is to fluctuate, and your job is not to react. The financial industry profits from the gap between how we think we make decisions and how we actually make them. When you close that gap, you stop being a customer and start being an owner. Your goal isn't to be a brilliant stock picker. Your goal is to be a disciplined wealth builder, and the data is overwhelming. The simplest, most boring strategy is often the most brilliant. Be the tortoise. Let the hares run in circles. What's one bias you see in yourself? Acknowledge it in the comments. That's the first step to beating it. If this honest conversation helped you, please like, subscribe, and hit the bell. Thanks for investing this time in your future. Click on the next video that just popped up on your screen, and I will see you in there.